Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada, and I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. As we are approaching April 30th personal tax filing deadline, I want to share with you the best practices that we've helped our clients to implement so that you can also have an easy sailing at this tax filing season. But before I get started, make sure you give us a thumbs up if you like our video and hit the subscribe button below if you want to stay on top of the latest tax tip. Now with that, let's get started. The first tip I'm going to share with you is accurate rental income and expense reporting. Now the reason why you need to know this is because as a real estate investor, you're reporting your rental income. You are obligated to report your rental income that you receive, and you are also eligible. You have the right to claim all the reasonable expenses that you incur for the purpose of earning that rental income. It is important to understand that as a Canadian tax resident, under the law, you are eligible to deduct all these expenses that you incur for the purpose of earning the rental income. These expenses include, but not limited to, mortgage interest because you borrow money to earn your rental income, property tax of your rental property, insurance, property management fees, even cleaning fees, repairs and maintenance. These are all the expenses you are eligible to deduct as a landlord when you earn rental income. So make sure you keep all the receipts to support your claim and keep it in a safe place and organized format to substantiate your claim. As a real estate investor, it's also important to understand that certain expenses are not tax deductible. Now, what I mean is that, for example, when you purchase a rental property, you incur expenses such as the lawyer fee, because the lawyer helped you close the property, such as land transfer tax. Land transfer tax is when you purchase a property, you have to pay to the city or the Ontario government in terms of purchasing the property. These expenses are not expenses that are tax deductible against your rental income. It can still be tax deductible, but it is being added to the cost of your building when you eventually sell the building 10 years, 5 years, 19 years down the road, you would be eligible to claim the closing costs of your property as well as the land transfer tax as part of the cost of the building to offset against your future capital gain. The expenses are incurred, but it is not it's not deductible immediately. Now, another example that I can share with you that is not a tax deductible expense is called financing charges. If you are borrowing money from B lender, so not the top big 5 bank, but rather B lender, or if you are using a mortgage agent, sometimes they would require you to pay a lender fees. And these type of lender fees are tax deductible, but it's not a one-time tax deductible expense. Rather, it is deductible over 5 years. So it's also important to keep track of these expenses and you are deducting it in the correct, proper period over time. Number 2, sale of the property reporting. If you sold a property during the year, it's also important to understand there are different type of tax rules that could potentially apply. In 2023, the government imposed this anti-flipping rule, essentially requiring people who sell a property that they've owned under 365 days, taxpayers are required to report this type of sale as a business income. Essentially, 100% of the profit would be taxable when you sell the property within 365 days, unless you meet certain criteria. So if you sold a property within 365 days, you may want to look up the rules to get a better understanding of the tax implication of this type of sale. Now, on the other hand, if you sold a rental property that you've owned it for multiple years and you've always generated rents throughout the years, and you sold a property this year in 2023, it's also important to understand that you have to report the capital gain that you've resulted from selling the property. The calculation is not as simple as taking the amount of money that you received from your lawyer from closing. To properly calculate your capital gain, I have another video that you can refer back back to, we'll include it in the link above. When you sell a rental property, you might have claimed something called capital cost allowance or depreciation in the past on that particular property. If you sold a property that you've claimed capital cost allowance in the past in your prior year's tax return, you are now required to take that capital cost allowance into rental income in the current year, the year that you sell the property. And these capital cost allowance that you take into income, the proper term for that is called recapture. So you are required to report the recapture on your personal tax return when you sell the property. And this may not be an immediate clear information that you get from looking at your last year's tax return, and sometimes we have to go back to years of prior year's tax returns to make sure that we got the correct recapture amount. So it's important for you to keep copies of your prior year's tax returns, so then your accountant would always be able to go back to prior years to confirm the capital cost allowance that you've claimed over the years. Add them all up, put it all together in current year's tax return when you sell it, and that number is the recapture income that you would have to report. Even if you're losing money on the sale of the property, it's still worthwhile to do all the proper reporting because losses count towards something. Some of the losses that you incur, if it is considered business loss, you would be able to use that loss to offset against your other income in the same current year. If you incur capital loss in the event when you sell a rental property and you lose money on that rental property, that loss would also be eligible for deduction against other capital gains that you've reported in the current year or 3 years prior, or you are eligible to carry forward that capital loss to the future indefinitely. If you make money from the sale of another property in the future, you would be eligible to claim the capital loss and offset against the future capital gain that you make. Okay, the third tip, home office expenses. Some of our clients do not like to claim home office expenses. Some of our clients would not want to miss claiming home office expenses. For as long as you only have one dedicated space, one space to operate your business out of, and that space is in your home, you would be eligible to claim a portion of your home expenses against your rental income. The key here is to make sure that you have a copy of your floor plan and mark down exactly where your home office space is, and only the size of your home office space in relation to the entire home space would be eligible. Essentially, if you have a dedicated office space of about 100 square feet and your whole entire home is about 2,000 square feet, you would be eligible to deduct essentially 5% of all your home expenses, including utilities, mortgage, interest, property tax, internet expense, some repairs and maintenance as well. So you can deduct 5% of all these expenses against your rental property. One word of caution though, if you are also renting out your basement or you're also using your home office for for your employment purpose, you might not want to claim your home office expense against your rental property because you don't want to risk losing the opportunity to claim primary residence exemption. So depending on how the situation that you are in, you may or may not want to claim that home office expense against your rental portfolio. Number 4, capital cost allowance strategy. Now, what is capital cost allowance? Capital cost allowance is the tax term that essentially represents depreciation of your property or the wear and tear that's incurred on your property. And CLA uses CCA term, capital cost allowance term, to describe that wear and tear expense. Now, you're eligible to claim that wear and tear expense on an annual basis against any capital improvement or your building against your rental income. So let's say you purchased the property for $500,000. The building was just purchased last year. You're eligible to deduct the capital cost allowance rate, the wear and tear of the property. And as of the time of recording of this video, 4% is the capital cost allowance rate. So you can claim 4% of the $500,000 against your rental income. Now, but that is only allowed if you are making rental income, net rental income, before you claim capital cost allowance. You are not eligible to claim more capital cost allowance if you are already incurring a loss. So you cannot use capital cost allowance to incur a bigger loss, or you cannot use capital cost allowance to create a rental loss to begin with. You can only use capital cost allowance to reduce your rental income to net zero, essentially deferring it. Now, capital cost allowance is also a deferral. Like I mentioned earlier, I use the term deferring it. Capital cost allowance is a deferral mechanism. Essentially, similar to RSP, the year that you claim the capital cost allowance, you do not need to pay tax. So the year that you contribute to your RSP, you don't need to pay tax on the amount of contribution. Same idea. Now, the year that you sell the property, which I mentioned earlier, any capital cost allowance that you've claimed over the years, if you claim $1,000 in year one, claim $2,000 in year two, claim $3,000 in year three, so you claim a total of $6,000, and year four you're selling the property. In year four you have to claim all $6,000 that you've claimed in prior years, a total of $6,000, back into income called recapture, the year that you sell the property. So then the question is, Cherry, is it worthwhile taking capital cost allowance? It also goes back to number one, your plan with the property. Have you ever lived in the property before? Are you planning to move back into the property? Those questions will help determine whether a capital cost allowance should be claimed or not. What are your marginal tax rate? If the property is in the corporation, typically we claim capital cost allowance all day long because the tax rate today is 50%. Tax rate 10 years down the road would still be the same 50% anyway. It's not totally 50%. You can get refundable tax and all that other stuff, but just saying the same tax rate now versus same tax rate later, I may as well just take advantage of the time value of money. Now, if you are owning the properties in your personal name, it may be a different story depending on your tax rate, marginal tax rate. As we all know, we have a progressive tax system in Canada. So the more money that you make now, the more tax that you would have to pay. If you're anticipating that you're going to make less money in the future, chances are I would recommend you to claim capital cost allowance. When the year that you sell the property, you take it all back into income at a lower tax rate. That's how we kind of save some money by claiming the capital cost allowance. Now, capital cost allowance is not just restrictive to claim the wear and tear of the building. If you are operating an Airbnb or you are doing an all-inclusive rental, typically the furniture and fixtures would be part of your offering. And these newly purchased furniture and fixtures and TVs and all these other equipments, they are all new, brand new, and as a result, you will have to be required by law to capitalize these expenses. And therefore, you cannot write it off all in the same year. What CLA does is that they treat these type of furniture and fixtures and equipment a different type of capital assets on your in your rental portfolio, and they allow you to claim 30% of the expense every single year on a declining balance basis. So essentially every year you would be eligible to deduct some of that expenses, and so you would still be governing by the same rule. If you are creating a loss, you would not be eligible to claim the capital cost allowance, but if you have rental income, you would be eligible to claim the bigger capital cost allowance on these type of assets that you own. Number 5, automobile expenses. You are essentially eligible to deduct any expenses, reasonable expenses, that you incur for the purpose of earning your rental income. This would include automobile expenses for driving around using your own personal vehicle to manage your rental portfolio. Now, the key here with automobile expenses deduction is the logbook. You would be required to, by law, to keep a logbook, essentially telling CLA that on these particular days you are claiming, you have these trips that you've made to manage your rental properties, and these would, let's say trip number 1 would be 50 kilometers, trip number 2 would be 30 kilometers, trip number 3 to go to Home Depot and buy the toilet for your rental property, it would be 20 kilometers. all these would add up. Let's say for the full year, you've only driven 20,000 kilometers with your car. So essentially 5,000 kilometer rental, property management purpose, over 20,000 kilometer on the car. Essentially 40% of all of your expenses, automobile expenses, would be tax deductible against your rental income. So the logbook, number one, the logbook is very important. Make sure you keep track of the logbook. Number two is to make sure that you keep track of all your automobile expenses. This include gas receipts, CAA membership, maintenance and repairs. There is very little license and registration these days, but if you still have some of that, that would be tax deductible as well. Insurance would be tax deductible. If you purchase your car, the capital cost, the purchase price of the car, a portion of it would be tax deductible. And if you lease your car, you would also be eligible to deduct a portion of your lease amount as well. But keep in mind that whatever you are tallying up, you're deducting, the maximum you would be able to claim is the business use percentage, essentially the property rental use percentage. So in our earlier example, it would be 40% of all the expenses that we just mentioned. So you'll never get 100% of the deduction, but you will be able to claim the rental use percentage of your automobile expenses. Now, number 6, this is a really important tip, documentation. Now, the reason why it's important is because a lot of us are under the impression that, hey, I spend the money, I have my credit card statement, I have my bank statement, that's all I need for the purpose of filing the tax return. The reality is that we as accountants and bookkeepers out there as well, they're using the bank accounts and credit card statements for the purpose of reconciliation, to make sure to ensure completeness of your return, ensure completeness of your expense deduction. But it is not really the what CRA is looking for when it comes down to audit and substantiating your claim of expenses. CRA would actually want to look at the initial invoice, the actual invoice that you get. The invoice also needs to specify the business number, business registration number of the vendor in order for you to be eligible for deduction. So you may use your bank records, credit card statements to do your bookkeeping and to make sure that everything reconcile, but that at the end of the day, you still would need to keep track of all your receipts and documentation to substantiate your claim. And some of the expenses that you incur, you may actually not get an invoice. As an example, I'm currently working with my tenants and they are moving out, and the tenants are asking us to provide 2 months of rent so that they would leave us. I know it sounds a little ridiculous, but I'm so happy that they are also leaving, so it would help us to sell our portfolio, sell our house earlier than we expected, we anticipated. But throughout this process, there is no invoice in our negotiation. There is only some sort of email exchange. So it's important for me to keep track of all these email documentation in terms of the offer of 2 months and what they agree on. When we send the email money transfer, we'll also note that it's lease termination fee, and that together would be sufficient enough for us to claim our expense against the rental income. But without that type of documentation, you would not be able to claim the amounts e-transfer over to your tenant, because CRA doesn't know what that is for. So you need to provide proper documentation for everything that you do. And sometimes, unfortunately, it's not easy. It's not as simple as just having an invoice or credit card statement or e-transfer. It also goes beyond the basic documentation. Okay. Number 7, T1 compliance deadline. A lot of us already know this. T1 filing deadline, generally, they are April 30th. Unless you are a self-employed individual who has a filing deadline of June 15. I wish the deadline could be spread out over the years, but unfortunately, there's only 2 deadlines, April 30th and June 15. Now, all the tax payable that you would have to pay must be paid by April 30th, regardless of whether you are self-employed or just regular individuals that are not self-employed. Their tax payable deadline is always April 30th. The tax return filing deadline could be different between regular people and self-employed people. but tax payable is still April 30th. If you're self-employed and you have an HST filing obligation, your filing deadline is June 15 for your HST return as well. But the payment deadline for your HST, again, is also April 30th. So it is important to make sure that you make all your payment before the payment deadline in order to avoid any interest expense being charged by CRA. Ensuring compliance with these filings would help you avoid any CRA penalties as well as interest. And remember, if you're late for 1 year, the first year's late filing penalty is 5% on the amount outstanding. If you are late for the second year, then the second year, the late filing penalty is 10% plus interest, 10% on the amount due plus interest outstanding. So it could turn quite substantial. The first year, they may slap you in the hand a little bit, but then second year, they double the amount of penalty that they would charge you. Okay, number 8. Presenting to your joint venture partners. I almost work exclusively with real estate investors. It just came to my attention that a lot of real estate investors, they are not getting the information that they need from their joint venture partners. So for those of you who don't know what joint venture relationships are, essentially two parties come together, decide to purchase a property together. And typically in this type of arrangement, one party is the working party and the other one is the money party. So the working party would be the one that is preparing all the income and expenses and sharing that information with the money partner. And the money partner would then use that information to file for their own personal tax return or corporation tax return. And it just boggled me a lot that a lot of our clients who are being the money partners in the deal are not receiving any relevant information from their joint venture partners. So I'm just using this opportunity to share with you that if you form a joint venture, it's important for you to make sure that you are providing the information with your partner so that they can also report their share of income and expenses on a tax efficient manner and on time as well. Now that we've covered 8 tips for real estate investors to have the best tax filing season, it's important to reiterate the fact that, hey, when it comes down to tax filing, it is a lot of education, it is a lot of attention to detail, it's a lot of documentation. And if you keep all that in mind and apply it on a daily basis, you will always have a breeze in your tax filing season. Until next time, happy Canadian real estate investing.